Are you being bombarded with some really scary headlines when it comes to mortgage rates in the housing industry? If so, stay tuned because in today's video, I am going to be doing a deep dive with one of my trusted lending partners, giving you statistics, data, facts, and figures about what you need to know so that you can make the best, most informed decision for you and your family. So that's coming up in today's video. Hi everybody, welcome back to my channel. My name is Caitlin Martin and I am a local Nashville real estate agent and founder of the Caitlin Martin team, powered by Weicker Realtors, the Andrews Group. I specialize in working with savvy sellers who want to sell right and sell smart, as well as working with out-of-staters looking to relocate to the Middle Tennessee area. Now, if this is your first time stopping by my channel, thank you so much. Please feel free to click subscribe down below so that you are notified anytime I release new video content. So in today's video, I am talking with Mike Thayer of Novus Home Mortgage. They are one of our trusted lending partners. And one of the reasons why I'm sitting down and having this conversation with him is because we have seen so many headlines out there. And as real estate and mortgage professionals, when there are media headlines that are out there, if we are not actually giving you facts and figures and sharing what is really going on, we're not doing our job, because there's a lot to know about what's happening just so that you can make the best, most informed, educated decision for you and your family. So in today's video, I am sitting down with Mike. This is going to be a lengthy video, so it may be one that you need to stop and come back to. Also down below, I've linked the different chapters, but we're going to be talking about, is the bond market on the verge of a crash that's going to send mortgage rates skyrocketing? Is it true that for millennials, this is literally the worst time to buy? They are such an unlucky generation. We're going to be talking about that. We're going to be looking at, are we also headed for another crash? What contributed to the crash of '08 and what are we dealing with now? And again, we're going to be bringing it back to local Nashville statistics because, as I've always said, real estate is hyper local. So I hope you will enjoy this conversation today with Mike. If you've got any questions, again, his contact information is down below with some of the videos that we will reference in our interview, as well as my contact information is down below as well. So if you ever have any questions, please don't hesitate to reach out. But without further ado, please enjoy this interview with Mike Thayer. All right, joining me today is Mike Thayer with Novus Home Mortgage. Mike and Angela Tobias, they together are one of our preferred lending partners that we love to work with. And one of the reasons is just because you guys are so great about education throughout the lending process and just providing people options. And so right now, in our real estate world, in the mortgage world, we are dealing with a lot of headlines that are doom and gloom. They're painting a certain picture, right? And so even on my real estate side, I'm still coming to you guys going, hey, I'm hearing these headlines. Tell me what's going on. And so that's why I wanted to be able to talk with you and be able to provide this to others, because you guys do such a great job of educating and explaining things in a way that everyday people can understand, especially if they're not in the mortgage world like you are. So thank you for joining me, and I am excited for our talk today.
Absolutely. I appreciate you guys for inviting us. And, we take a lot of pride in being able to explain these complex topics and just, peeling back the layers and just helping people understand, because it's scary for them. It's what we do every day, but yet for them, it freaks them out. And a lot of times they're almost paralyzed by fear because they just don't know who to call, who to turn to. And then when they go online, they're seeing God knows how many different variations of the same thing, and it just compiles to their anxiety. So, it's anything that we can do to help, bring the clarification to whatever the topic might be. We're always glad to help with that.
Well, and that's the thing. So because we'll talk about a couple of headlines here, but one that I saw and I brought to you guys, and we've already discussed it, and now I want to be able to share it in case other people are talking about, but they're saying that our bond market is like on the verge of just having a major catastrophe and going to cause interest rates to skyrocket to these extreme numbers, right? And so
Right.
you see that, and maybe you're just kind of observing the real estate world, observing the mortgage world, and you're not quite sure. You see that, and that seems really scary. But I would love for you to dive into what you guys are actually looking at and what you're seeing, and what is playing into that, and where the truth really lies.
Yeah, I mean, it's you can take anything, good or bad, and spin it whichever way you want to present. And there are some good things happening. There are some bad things happening. And that's the one thing about us. We're going to tell you what you need to hear, not what you want to hear. And this whole conversation is complex just because it's multi-layered. It's not just a very simple, boom, here's your answer.
Exactly.
It goes way back, and we've got a couple different videos we're in the process of putting out there. They're not ready to go yet, but a lot of people don't understand what QE and QT is, which is quantitative easing and quantitative tightening. And that's where the Fed gets in and they're buying bonds and selling bonds and stuff like that. And people are like, well, why are they doing that? And a lot of economies do that when there's situations going on where they need to prop up or help stimulate or whatever the situation might be going on. So like after 9/11, after COVID, there's situations like those that everyone thinks of after the housing collapse, in 2006, where the federal government will step in and help bring fluid money into the financial sector to stabilize it. And they do that by buying the bonds, and it helps lower the rates to stimulate lending. And there's other things they do with the banking system and everything else. But when they go out there and they're buying all the bonds, and you got to understand the bond market as it relates to mortgage rates, the higher that bond price goes, or the higher the bond yield goes, that's what pushes mortgage rates down. So for all you people that are thinking, hey, I'm going to wait for the 3% rates to come back out, well, you're essentially waiting for another 9/11, another COVID, another housing collapse. And I'm telling you right now, this is not what we're going through right now. It's not another housing collapse. So that's not going to happen. So it's that whole balance of QE, QT is in play. And why I say that is because the Fed stopped buying bonds and they started to sell the bonds. And when they started to sell the bonds, you basically had to allow the normal supply and demand to take place again on Wall Street. Whereas for the last several years, you've had the federal government coming in buying everything, which just kept on driving the yield up, which kept on driving the mortgage rates we saw lower and lower and lower and lower. And that's why we saw the historically low rates. Well, the Fed can't hold on to all those bonds forever. They've got to unload them and sell them. So they've been doing that. And they've been selling them and selling them and selling them. So there's a supply that keeps on hitting the market over and over and over every month. The other issue you've got going on with the bonds, the debt ceiling. You heard the conversation about that a couple months ago where they're all arguing about that. Oh, we got to raise the debt ceiling again. Well, when they do that, they go sell more bonds, which is another surge out there. So there's a lot of stuff going on there. You've got banks that are trying to raise some capital, and sometimes they're selling their bonds as well. So, I mean, you've got a lot of contributing factors on the bond market. What a lot of people don't understand, and the reason why I keep on talking about the bonds, that's what drives mortgage rates. Nothing else. That's it. The performance of a mortgage bond is what determines the rates that we see on a day-to-day basis. It's nothing else. And the main thing that drives a mortgage bond is inflation. So depending on what's going on with the inflation, unless the Fed's stepping in and manipulating it through QE or QT, where they're buying or selling bonds, you pull that out of the market, which is now what's happening to some extent, other than the Fed's flooding the market with bonds. It's all driven on inflation. So as inflation starts to go down, mortgage rates will go down. So when people are asking us, why do we know mortgage rates are going down? Because inflation's going down and mortgage rates follow inflation. So that's kind of giving you a little bit more than what you asked for. But the bond market itself, it's trying to adjust to what's going on. The other part of it is you've got this battle going on between Wall Street, big business, and the Fed. The Fed is taking this very firm, hawkish approach where they're like, we're going to raise rates. We're going to keep raising rates until it's 2%. That's our target rate. We want inflation at 2%. Don't care. Get out of our way. We're getting to 2%.
Are they trying to raise the rates as a way to tamper inflation?
Good question. Good, excellent question. I'm glad you asked that. So many people, that's a huge misconception in the market. People think when the Fed raises rates, they're raising mortgage rates. I can show you chart after chart after chart that proves that wrong.
Right.
You listen to what the Fed's saying or what the news is saying, and half the time, more than half the time, the news is wrong. But they say short-term rates. Is a mortgage a short-term rate? No, it's a long-term. Short-term is a credit card, a car loan, a HELOC, a 2-year treasury, or a 5-year treasury, a 10-year treasury. It's something that's basically 10 years or less. So when they're adjusting the short-term rates, they're adjusting stuff like that. And they're doing that because they're trying to slow down spending. And you think about it this way. You got your credit card and you're just out shopping today, no big deal. Hey, the Fed raised the rates a half a point. No big deal, because you're not even going to see that on your credit card for at least 30 to 60 days. Simply because you're in the middle of your billing cycle now. So it's going to take at least 30 days before they can implement it. And then you've got to get your next billing cycle later. So it's at least 60 days before you get it. A half a point increase, even a point increase, by the time you see it cycle through, you're not going to notice it. So they're going to do another rate hike, another one, and it's going to take 6 to 9 months before you actually go, whoa, you notice a difference. And at that point, you start to curb your spending. And that's why you hear people say it takes 6 to 9 months for what the Fed does to actually get materialized into the data, into the reports, so that you can see what's actually happening. And so when people think the Fed's going out and raising and lowering mortgage rates, it has nothing to do with the mortgage rates. They're doing that. They're raising and lowering the short-term lending rates to try to curb inflation. They're trying to curb your spending. And by doing that, you can actually see on the charts, mortgage rates typically will drop at the same time because inflation erodes the return on a bond. So as the Fed is actually fighting inflation by raising short-term rates, you can see on the charts, historically, mortgage rates will drop. Now here in the last couple, say month and a half, they're all out the window. It's been just crazy chaos because everybody's fighting between the Fed taking that hard hawkish stance, Wall Street saying, hey, you guys are going too far. Now you've got the banks and Wall Street investment companies saying, some of them are like, you're going too far, or hey, we're not having a recession. Everybody's got their opinion at this point, and they're all bickering. And it's basically who's going to win.
And it's their opinion on what's going on with the economy or what needs to happen to help the economy. Is that what they're...
Are we going to have a recession or not? It's all they're debating about. Are we or are we not going to have a recession? That's it. It's been this whole talk about, can the Fed basically land the plane? That's the phrase they like to use. Can they land this plane softly and bring it in without messing up the jobs market and without destroying the economy? And I'm going to tell you right now, no, it's going to crash.
Well,
Now, when I say when it's going to crash, that's probably a bad choice of words from a housing point of view.
we're not
But
talking about a housing crash.
no, we're not talking about a housing crash. No, we are not talking about a housing crash. You got to, when you understand all the numbers, there's nothing about today that is even remotely close to 2006 to 2008.
Yep.
Nothing. We were overbuilding. We had too many homes. We don't have enough homes right now. We had underwriting standards. We literally were giving away 100% stated income, 100% finance, stated income, no reserves. I think you only had to have like a 660 score on investment properties.
And
Investment
this
properties.
is back then.
Oh, this is back then. Yeah.
This is all the puzzle pieces that had to fall that caused what happened and,
Yep.
caused the housing crash.
Yep. The other big deal was back then, we had already seen so many people using their houses as ATMs. We haven't seen that yet. We're going to see some of it, but there's so much more room. They have so much more equity. Back then, they didn't have it, the equity position. They'd already eaten it up over the previous years. And the thing that people don't understand is when you go back and understand everything, the housing collapse was not 2 to 3 years. And that's what most people, when you ask them, how long did the housing collapse take place? Or what was the time period? I was 2 or 3, maybe 4 years. No, it goes back to 1995. There was a piece of legislation that was signed into law that opened up everything. And then if you look into some of that legislation, it created this opportunity for the national builders to go into all the cities and work with the governors and the mayors to build all these homes. You also had the .com crash, so people were already into speculative building. You had the stock market hit all-time highs at that time, so people had tons of cash and they were looking for the next best thing to invest in. Voila, here comes the government with the real estate. That's why everybody was into the market with buying real estate. And there was just too much supply and not enough demand. So there's nothing about it. You can get here, we can go about that all day long. There's nothing about that time and this time, the current day. We're not going to have a crash like that. We are going to have a correction. You're going to.
And you just said a correction. Like
a correction, and I kind of.
Correction does not equal crash.
No. I think personally, and you're not hearing this in the news. It depends on who you're listening to, and a lot of times the news gets this stuff wrong, and we're going to hammer that several times. And God bless the news. I wouldn't want their job. I wouldn't want the Fed's job, but a news person, they don't know what we know about, the real estate or the lending world, yet they're given an article and it's like, hey, you got to go summarize this and put it out there in 20 to 30 seconds, go.
Well,
and
that's the thing. Like, I worked in the news for 4 years after college. I have a journalism degree, and that's something that I learned very early on is, even local stations, right? They will get stories syndicated down from the national. So if you're an ABC station, it'll come down from ABC, or with Fox or NBC. You'll get these stories that come down and they will have run on the national news. And then you have to take something that's a minute, 32 minutes, and it's up to the producer to cut it down and to fit it into 20 or 30 seconds, because in a newscast, they want everything to be so quick. And that's where all of a sudden you're leaving somebody, and I was a producer. Like, I can tell you, it's not, you're doing the best you can to summarize what a minute 30 or 2 minutes says in 30 seconds. But you're not, as a producer, you're not an expert in these different topics. At the time, I was not the real estate expert. So, and, I wasn't dealing with a lot of real estate stories, but, once you're in the world of real estate and in the mortgage world, we work hand in hand to be able to provide people the best advice, professional advice. But like a news person that's sitting there they're not going to have the expertise of being in the industry. And I think a lot of times that's where all of a sudden some of the most intricate pieces start to disappear. You know, I'll never forget, there was a story posted by a local station probably like a year and a half ago, and they posted it to their Facebook page, and it was saying this, I mean, it literally looked like a dilapidated house in East Nashville. They posted it and they're like, this house is going for $500,000. And I read the article. There was no realtor commentary on it at all, but it was all meant to rile up the emotions of like, oh my God, Nashville's so expensive. You have to get a shack for 500,000. But what they failed to say was, when you're a real estate advisor, you're looking at what the highest and best use of said property was. And in East Nashville, it was geared towards developers because that house wasn't even worth a fix and flip, you know? So it's things like that. Like you said, when you're looking at the news and looking at these headlines, you know, I have a unique perspective having been in the industry of just, it's not that they're bad people, it's just they're not the experts, and a lot of times trying to take something that's complex. I mean, even you explaining what's going on with the bond market, that's not something that you can just spit out in 30 seconds to where the mass population is going to understand it. So that's where, for me, that's why I want to be able to have these conversations and be able to share them, because we're able to provide the commentary and the explanations that, you know, a lot of times the news isn't going to take the time to do the deep dive, because for them, everything's got to be quick and just move fast. So, you know, that's that. But you were, prior to that, we were talking about the correction that you believe is coming. And so, you know, would love to know more about your thoughts on that in terms of just a correction. And again, correction does not mean crash.
Correction. Everyone goes off on a tangent in this business, or in it not necessarily this business, but we've all become such an instant gratification, instant society about everything, and you get one word built up in your head or a stigma about it, and all of a sudden, boom, correction, crash. You think 2008 or whatever, and it's going to be terrible. And no, market corrections happen all the time, and a lot of times they're healthy. There's sometimes you have a more significant correction or a significant crash, but you've got to have some balances to every market. It cannot just be gung-ho. You're constantly going up, 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 up. You've got to have some ebbs and flows and some corrections to everything. So if you think the correction's bad, you got to reevaluate that. I want to show you some. I want to show you the bond market, actually, because I think this would be a great time to give you guys a little insight on this. Bear with me, because I wasn't going to do this initially, but I think this will be awesome. Absolutely. I think this will really help bring a visual to what we're talking about. Yeah, because when people see this, and typically when we're meeting with clients, I always will show them this, because this helps people understand when we're talking about stuff, when it's dealing with the market, the rates, why things are moving, how things move. This is where we go, and this is what helps connect the dots. So let me try to go ahead and share this real quick. All right. You see that with all the black and red, the red and green?
Yes, can see it.
All right. So what this is, you can see the timeline down here. So every one of these little marks, they're called candlesticks. And what this shows us is it reflects the movement of how bonds were traded on Wall Street on that given day. Okay. So like today, bonds right now, the average, the bond coupon they're using right now is this 5.5. And we're not going to get into that because there's tons of different bonds, but this is the primary target. Okay. And it's trading up right now. So right now it's down here, and you can see how we've had all this red. And what this basically tells you right here, at a quick glance, what I said earlier, when you have the bonds going up that means the mortgage rates are coming down. The exact opposite is true. When the bonds are going down, the rates have got to go up to offset. So because of all this bickering and all this conversation about everything, surge in bonds, coming to the market and everything else, you're seeing a deterioration in the bonds. What we're ultimately hoping for is come September, I think it's 19th and 20th, the next Fed meeting. Between now and then, they'll finally see that the job market is not as strong as they think it is. Because that's really what's going to it's really the fork in the road. And we're going to get into this job stuff in a minute, but I don't want to get too far off that. But that potentially can create a rebound here. But ultimately, this shows how mortgage rates move throughout the day. And then when you have these big movements like this, that's showing how much the rate actually changed that day. So when a client calls and they say, well, what's the rate right now? Well, it depends on what the market's doing. And that's not just me saying that. I mean, it really depends on what the market's doing. And if you've got a day where there's major movement, it literally can change 2, 3, 4 times throughout the day. Now, is that common? No. And you can see that on these days where there's all these little smaller movements. But there are days where you have major swings or where there's a lot of volatility in what's going on in the market. And then let's go back. See if we can expand this back. See if we can take it all the way back here. See if it'll let us do it.
Oh,
so this, remember when I was telling you earlier when the Fed announced they were going to start to sell bonds? Mm-hmm. That was at the end of 2021. And you can see when they announced, because up to this point, they kept on buying and buying and buying, and it kept the yields high. And this is when we had all those historically low rates.
And that's when our market was absolutely white hot.
Exactly. And then when they came out and said, hey, we're done. We're going to announce QT, quantitative tightening, and we're going to start selling. We're no longer buying. We're going to start selling everything. What happened? Fell off a cliff.
Movement through 2022, which, I know we felt as we were going through it.
Yeah. I mean, this is the main reason why rates went up so fast. Now, combined with the fact, and we're going to get into this in a minute, the inflation up to this point in time back here in 2021, the Fed kept on saying they thought inflation was transitory. They didn't believe it was going to be an issue. In fact, I'm going to show you some comments where they were saying, hey, we want more inflation, bring it on. And they got it. But at that time, if you look at the numbers, you could see inflation was taken off. And as I said before, inflation and mortgage rate follow each other. And once the bond market once the Fed stopped buying, and then all of a sudden everything came home and people realized what was going on with inflation, that's what accelerated everything. And it was off to the races. And I like to describe it as they're like two buddies, where one goes, the other one goes. And inflation took off. And when the bond market woke up and they're like, wait a minute, where's he at? Where's my buddy? He took off running to find his buddy. And that's why the rates took off like they did. I mean, it's literally that simple. And you can go back in time and see that hit. Actually, you know what? Let's show that real quick, because that's just.
Well, I think it's super helpful to see charts just as you're further explaining what's driving, what we've been seeing.
All right, you see this when inflation drives mortgage rates?
Yeah.
All right, so here is the 30-year mortgage rate. That's what it's averaging going through. You can see how it trended up. And then here is basically inflation.
And they do.
Here is that little mild recession that took place with COVID. Remember me telling you about QE, quantitative easing? That's where the Fed's jumping in and buying mortgage bonds because they're trying to stabilize the market right after a big financial situation or issue, everything shut down. They were like, we've got to figure out some way to get cash into the system to stabilize the market. There was no other thing to do. I mean, hindsight, you look back and say, well, why'd they do it? There was no other option. I mean, everything was freaking shut down. You had to put everything you had on the table and throw everything at it and just figure it out later. And that's what they did. And you got the checks in the mail. That led to problems down the road. We're paying for it now. All the others bailout money. I mean, it comes at a price somewhere. We're seeing that. And as soon as they said we're done buying the bonds,
then
rates took off. They were like, where's my buddy inflation? But inflation already took off way back here. Way back here. Like a year ago, way back here. And let me go find one more real quick, because while we're talking about it, here's one of the Fed chairs. Not concerned with inflation running away from us. April 2021, or April 5th in 2021. The Fed needs inflation expectations and real inflation to rise. May 6th, 2021. By the end of the year, I expect inflation to be between 3.5 and 4% and drop in 2022, August 27th, 2021. Now, if we go back to this chart, we're back on the inflation chart.
Yep, it's back.
Okay. Where's this timeline at? They're sitting here saying we want inflation and we're not concerned about it.
And then it was already going.
It was already going.
Yeah,
And the reason,
especially that last one was for August of 2021, but you can see clearly it was already taking off even before July. Like it looks like it took off maybe somewhere in April, May
yep,
of 2021.
And I point this out, and again, I am critical of the Fed at times, and every time I am, I make a statement. I don't want their job.
Sure.
Because it's the perfect Monday morning quarterback. You're never going to be right. You're always going to be wrong. And when you're right, no one's talking about you. Nobody. But everyone is coming after you when you're wrong. And the thing about inflation is, we're just going to start flying through charts now. The thing about inflation is it's a 12-month rolling average. Let me bring this one down real quick.
Sure. And as you're pulling that up, so if we're showing that inflation drives mortgage rates, on your side, are you able to see what's happening with inflation to kind of predict where rates might go in, in the short-term future? How about that?
Oh, that's like you were in my brain, girl. That's good. If I can get this chart to show.
There we go. I see the new chart.
All right, that's not the one I wanted, but this works. This will help us.
Okay.
This is the largest component of this. Actually, this will work really well. This is one of the largest, the largest component of the CPI. This is what the Fed's looking at, and the consumer price index. And you'll see this 43%. It's not 50% of the number, but it's a huge piece of it.
Okay.
I grabbed an owed one. It's only a couple months old, but it ain't gonna matter. The point of showing this to you is inflation is a 12-month rolling average. All you're really concerned about, an easy way to look at this is, what's the number coming on the report this month? What's the number dropping off from 12 months ago? And then what's the new average? And as you can see in this chart, we've got a bunch of higher numbers from back in. We'll play like it's the April report just for conversation's sake, even though this is a couple months old. You can go back here and see the old April number.
Yep.
It was 50, but it was going up. And the thing to understand about the shelter number, shelter covers homes, apartments, anything, shelter, anything you think of shelter, it's in here. It lags it's either 14 or 15 months. It takes 14 to 15 months for this data to cycle through. So it's not a real-time number. It takes time. It's like, all of this is like it's like when you're in school. And let's say you're carrying an A average, and all of a sudden you got a D on a test. Now you got dropped down to a C average. It takes you several weeks or several months to get that A average back. It doesn't come back overnight. It takes time. It's the same thing here. You're talking about a 12-month rolling average. But the point of showing this chart is the previous 12 months are higher readings than our current months. So what does that tell you? One, I told you initially, shelter is the largest component of
Consumer
the
price.
CPI calculation. And you can see all of these much higher readings are going to eventually drop off. And in this chart, it was down to 0.42. So as these are being replaced with new readings, inflation continues to drop. So will inflation go down to the 2% that they want? 100%. The problem is they're not going to be patient enough to wait for this to happen. They're going to overshoot. They're going to force the issue. They're going to mess things up. And that's what's going to trigger the recession. It's going to be a mild recession because they trigger it because they're over anxious. They won't they say they look at the trending data. They got blinders on. They're looking at what that report says. And until that report says 2%, they're not stopping. And that's exactly what their comments say. I've got their comments, and we're going to get to that in a second. Their comments, if you listen to them, they always reference 2%. Until we get to our target rate of 2%, job's not done. We're going to keep going.
Okay. So
Inflation is dropping, people. You got to wait and let some of this stuff cycle through, especially your most biggest contributing factor that makes up 43% of your number. And then if you bring that back to your big, this was a chart I wanted to show. If you bring that back to your big, I grabbed both of the wrong charts. So these are both two months old, but they still show the same thing.
Sure.
So this again takes all of the data in the line, but it's still the same thing. You've got all of these lower readings replacing all of these higher readings. Another way to look at it that's a little bit cleaner is this is a more simpler chart, but I wanted you guys to see the 12 months to understand when I'm saying 12 months, what does that really mean?
So when you're getting a reading month per month, it's not in live time
no, it's always delayed. It's always
right.
Yeah.
Which I guess if that's delayed, then as the Fed is trying to make these decisions that then have a trickle down effect to what happens with our mortgage rates, they're basically having to make their best guess as to what to do.
100%. And that's where I made the comment, they're not going to be patient. They want it there, and they want it there now. Well, I get that. And that's half the frustration with all of this right now. Yeah. We on our side, on the mortgage side, we started saying back in the first of the year, rates are going to be, I'm on record, on video, saying mortgage rates are going to be in the fives. Don't know if it's going to be the high fives or low fives, but they're going to be in the fives by 2023. No, 2024. I'm losing my years here.
I know they're all starting to blend together.
Yeah, when you're looking at this, it all does come together. There's still a possibility that happens. Most people think I'm freaking nuts right now, but there's still a possibility that happens, because when you look and you understand the numbers, I don't have a crystal ball.
Sure.
But I know how to follow the numbers. And when you follow the numbers, you know the largest component of this core CPI is your shelter, and then everything else is dropping. I want these other two charts, but I think they're on my other computer. I'm going to keep talking to you as I go grab these real quick. If you know where all this stuff's coming from, and you can see this trending data, and you can take into account what the trending data is showing you, then you can make an informed and educated decision. And when we sit down and show a borrower this kind of stuff, because they're always asking us, when we sit down and say, hey, we're going to put you into a program, every time we close somebody since January of 2022, we've said there's going to come a point in time we're going to refinance you. We have the refinance program where we'll cover your costs, blah, blah, blah. And when the time's right, we're going to call you. Well, how do you know the time's right? How do you know rates are going to drop? And that's the biggest question we get right now is people are like, well, how do you really know the rates are going to drop? And then that brings up the whole conversation that people get into right now of, well, how do you know any of this? How do you justify anything that you're telling me? And when you sit down and you start to explain, you start to show them this, and you start to paint the picture and giving them this information and walking them through it and putting everything together, then all of a sudden it starts to click. And I've got one more thing I want to grab, because there is also history. I hated history in school, but now, man, I use it to my advantage.
It plays into needing to know these things, because again, you're talking about history. And so when there's a lot of fear mongering or very, clickbait type headlines out there talking about mortgage crash, this, that, well, history comes into play there, right? Because we already talked about it. What were the key factors that played into what happened? And those key factors that were in place that made up the perfect storm for the crash, those aren't existing right now. No. We're not seeing that. Even when it comes to like the rate of foreclosures, there's still a few out there happening, but overall, our foreclosure numbers are so small, especially here in the Middle Tennessee area, because people have so much equity built into their homes. Bingo.
That was where I was starting to go when I was talking about the ATM, people using their houses as ATMs and stuff like that. We haven't seen that yet. And people, you won't see a surge in foreclosures just because of that, because people have the ability to refinance it out. And then people are like, well, how can you do that? How do you know you can do that? I'm like, because they have a crap load of equity. When you have the resources to make something like that happen, then it's easy. And they're like, well, how was that different from last year? Or not last year, but to 2008. People literally had no equity. And when you're hearing these numbers we put out there, these numbers are leaving in 20% equity in their property. We're not pulling all the equity out. Whereas back then we pulled it all out. These numbers, when you're hearing the average American has between $200,000 to $270,000 worth of tappable equity, then that means you're leaving equity in the property. So if they had to sell, it still covers real estate commission, it still covers taxes to sell, it still covers costs to pay for sellers' closing costs, buyers' closing costs, and still walk away with money.
Yeah.
That was not present back then. That's a huge reason that nobody talks about. Nobody talks about that. But that is a huge reason why.
And that's also something that on the real estate side, people have been asking me like, oh, we've seen home prices decline. We've seen these price drops as they're watching, Zillow or realtor.com or whatever it may be. But if you actually go and look at like our RealTrack stats, they show that still it's not as 100% live time. I mean, it's a month delayed in terms of the statistics that we get, but it's still showing that everything in Williamson County in particular is selling for right at around 97+% of list price. So yes, you may see a price drop, but we're not talking about all of a sudden, homes taking these massive declines. It's just, it's still right there within about 3% of what the list price is. So it's not a major hit to what's happening.
Yeah, you've got to. Hold on, there it goes. You got to totally take it into consideration. I mean, all the facts, and it's like I said before, you can take any headline out of context and spin it however you want to spin it. What are you seeing right now? I got so much stuff up on my window.
I still see the monthly core CPI.
All right, you see monthly core. So we want to see Fortunately, I can't see what I want to see. Come on, man. It's live TV, man. When it's live TV, it always messes up. Here we go.
Again,
all right, so there's this one. And then, so now can you see the Consumer Price Index July 2023?
Not yet.
No, not yet. Let's see. Hey. The pups came back here. They want to participate in the conversation.
They always do.
All right. So here we want to grab. How about now?
Yes.
All
right, we're good to go.
Yes. So this is the most recent one. This is the actual all-in CPI number, the CPI chart. So you can see this is where it was starting back in the August 2022. It was going up, came down a little bit in November, went back up in December, came down, shot back up, came down, went up a little bit. So we're here right now. Okay. You've got all these high numbers. So even if we just stay right here, in this 5 or 4% range, it's going to get better. But they want it down to 2%, which I get. And 2% is good. But when they're going to continue to take a very hawkish stance and they're going to continue to hammer at this instead of waiting for some of this stuff to catch up, that's where the problem's at. That's where I disagree with it, because you got all of this high stuff, this 12-month rolling average, this stuff's got to drop off.
Yep.
So even if we just maintain what we do right now, all of this higher readings, as they drop off over the next several months, it's going to continue to drop, and it's going to continue to drop, and it's going to continue to drop. So comes back to what I said before. Are they going to come in and land the plane softly? Or are they going to come in for a hard landing? And I use the word crash it. They're going to come in and they're going to crash it. And they're going to crash it and put it into a little bit of a recession, which means they're going to stall the economy just a tad, is my prediction. It's going to be a mild recession. Mild recession is going to be fine. And actually, for all you people listening to this that are in the housing, that want to buy a house or want to go look at a refinance or do anything, you want a recession.
Because a recession does not equal a housing crash, and it does not also equal home values taking massive declines. Because I know...
Preach.
I know. Well, correct me if I'm wrong, but I know that it was either National Association of Realtors or Keeping Current Matters put out a chart that said 4 out of the last 6 recessions, we actually still saw home values appreciate.
Yep.
So, yes,
that was a keeping current matters one.
Yep.
Can you see housing stay strong through recessions?
I see it. Yep.
This isn't the most recent that you have, but this goes back. And I like this one because it goes back all the way to the 60s. Every single time, with the small exception of right here, that was a year and a half. And this was such a mild recession. When you really know the numbers, and we cover these numbers in our video that we go into why it's not another housing bubble, and it's so mild that you could really throw this one out. But this is where 2006 and 2008 was at, and this was caused by a lot of things, and it was the good intent of trying to increase home ownership that went wrong. And like I said, there was the Community Reinvestment Act. You can go look it up. Go Google, and it's no political stance. I'm not getting into politics here. Go Google President Bill Clinton's initiative to increase home ownership. And you're going to find a ton of articles that's going to lead you down and explain a lot of this stuff. But if you do not Google it that way, you'll never find it. It's all buried. But there's stuff there from the White House archives. And if you still can't find it, go out to our website and you'll find it there because we disclose it all. But
we can link the video down below for easy access.
Yeah, we can do that. But they were trying to increase home ownership, and they stripped away a bunch of the rules. They were opening up lending, and that's where they went out. And I said the national builders were meeting with the board of governors. The conference of mayors, to build 1 million new homes. Everything was working, and banks initially were not on board. And when they finally realized, hey, this is working, that's where it started to go bad, because that's when the banks started to expand the box more. And because the rules were stripped away, there was no longer any guardrails. Mm-hmm. The guardrails are gone. The safety guards were gone. Yep. There was nothing to protect ourselves from ourselves. And that's why people say the banks and Wall Street got greedy. And it's because once they figured out, hey, lending to these different areas and making these unique kind of loans was actually working, until we just got too aggressive with it. And getting out to where we're doing 100% stated for 100%, stated loans for 100% investment, which is stupid. And then 100% for 560 credit score with no money in the bank with a 55% DTI, stupid. That's not what you should be lending on. So all that stuff's out, and no longer is happening. But the point of this chart is housing stays strong through recessions. And even though we had the big collapse in 2006, you can see it's rebounded by a whole lot more than what was lost. And then the other piece about this is,
and not even just that though, look at the majority of where that's trending.
Oh yeah.
Of where, housing values are trending. Like, yes, and I get it, because the recession, back in 2008, the housing crash, it still is such a black mark in people's mind, and there's still so much fear around it. Especially if say somebody is looking to get into the housing market now, but maybe their parents were affected by the housing crash.
They're scarred.
It can feel very, very scary, because that's in still recent memory.
100%.
But when you were looking at that chart, the overall trajectory is trending up.
Absolutely.
And that's the thing is, there's statistics out there about, I believe it's 90% of millionaires are millionaires through owning real estate. And so, that's why when I feel like headlines are attacking our industries, and they're not telling the full story. It's really important to be able to look at this, because when you're looking at facts and figures, you know, that's not political. That
Nope.
they don't have, you're starting to pull the curtains back to getting
Right.
down to what the true statistics look like. And you know, so that's why I think, even though you can remember the housing crash and that can feel scary, if you're looking at housing overall, the big picture is it continues to go up.
Absolutely. I mean, it's one of those things of no matter how you want to slice it, dice it, compare it over time. I don't have the numbers in front of me, but you look at housing and compare it to any other investment, housing wins. And here, you know what? We're going to come back to this one real quick. I love this one. I did a post out for Instagram and TikTok for this. I should actually play this. You guys would love it. Let me play it real quick.
Sure. But I also think this mortgage rates and recessions chart's really good too. Just because again, you know, look, 13 to 18% interest rate.
This is why you want a recession. Rates drop during every recession. And this goes back to what I said before. Rates follow inflation. And I just proved to you inflation is dropping. So I'm proving to you rates are going to drop. So when I tell you to go buy that house because you can get it at a discount today with Caitlin, and then we refinance it in 9 to 12 months, maybe it's 18 months because the Fed screws up and they drag this thing out longer. You're still going to be able to refinance that rate down a point, maybe 2 points, and be in a much better position. But if you can buy that house today for 50 grand less, it sure beats what your alternative was of buying and paying 50 grand more a year and a half ago.
For 150 grand more. I mean, we saw that.
Oh, we're about to put some calculators out there, going to blow your mind. When you start to look at those comparisons, you start to think about 7% or 6% and like, why am I stressing over this? And it's no longer a big deal when you understand the numbers and you understand how to follow the numbers, and it becomes a non-issue.
Well, and so I want to ask you this, because I've been wanting to ask as we've been talking, because you're saying in order for those historically low rates to come back, we're basically wishing to have another major crisis happen, like a 9/11 or a COVID or something. So in recent days, though, all of a sudden, COVID has started making headlines again, and there's rumors swirling of lockdowns. So would you anticipate that if that came back, could that push interest rates down, or, you know, is that harder to base this time versus when it came around in 2020?
That's a very loaded question. Can you see Instagram right now?
I can. Sure can.
Okay. That I flat can tell you I don't have a crystal ball for that, because I don't have a way to predict how some microorganism, you know, like COVID, what's going to happen there. What I can predict with some certainty is looking at the historical data for the last 60 to 7 years, and look at the trending data and look what's going on, and give you a pretty good hypothesis of where this is going. Can I tell you 100% certainty? No, but pretty freaking accurate, and I mean pretty freaking positive that what I'm telling you is going to happen, because history shows us it's all in a cycle. We do it every recession happens every 11 years with an average every 11 years every 11 have that, I can't remember, it's every 11 years, and I think with an average of six years in between or something like that, but it's average of every 11 years. Hold on, I'll find that number and give it to you. But it's just like when you really start to understand that this is just a normal cycle we go through. We go through it every 11 years, basically, on average. And when you accept that and you understand that, it's no longer an issue, right? I shouldn't say it's no longer an issue because things cost more, but you're more informed and you're more educated, and it's no longer, fears no longer driving your decisions, and you're no longer listening to the news or seeing the stuff, it's clickbait and everything else on the internet that's trying to get to your emotions and freak you out. You can sit there and say, look, I'm not falling victim to a headline because I know the facts. I know how this stuff works. So it's like this one. We'll play this real quick.
Okay.
Sorry, we're having trouble playing. Why are you having trouble playing this when I want to play it?
And if we can't get it to play, again, we can always reference it and link it down
Yeah,
below.
it might be because we're doing this right now. But here's the chart I wanted to show. It's just a funny way to present it because we present it in a way of saying, hey, don't bet against the house because the house is 73-7-1, and I've got Gary Coleman in there, and he's like, "What are you talking about?" I'm like, "Yeah, man, house in 73-7-1 since 1941." He's like, "What?" And it's like, yeah, when you go back and look in time, everyone assumes just because you have this ramp up, and we're obviously keying in on the most recent 2007 to 2011. Everyone thinks just because you've got this big ramp up, you got to have a crash. Well, then you've got 2021 and 2022. Everyone's like, well, we had one then. We've got to have this crash. No, go back and look at all this, and we break it out, and everything's broken out and charted with these dates and times. And it's amazing when you look at the history of it. And when you start to understand the history and the trends, you start to remove this fear and the anxiety that you hear and read about online from these people that are just doing nothing but stirring up chaos.
Well, and again, it's one of those where people think, especially when it comes to the Nashville market, one thing that I've heard continuously come up in conversation with people is just, oh, well, Nashville's been so hot, it's got to be falling off soon. Like Nashville is bound to be a bubble that's going to burst. And, you go back and you look at what home prices are doing. They're still selling within 97+% of original list price. So we're not seeing the housing market take this massive crash. And again, in Nashville, we're also dealing with the basic laws of supply and demand. The amount of people that are continuing to want to move here, like we've got another 200,000 people that want to be here by 2025. We've got another 1 million coming to the state of Tennessee by 2040, with 57% of that landing in the Middle Tennessee area. We're continuing to grow. And those people now, I always tell people, it's like, are all of those people going to buy? No, but they need a place to live, those that can purchase. And Nashville does continue to draw in jobs that are better, higher paying jobs. So we've got a lot, when you're looking at headlines on a national scale, like I understand there are cities in the US that are nowhere near as well off as Nashville is.
100%. 100%.
But, we do have certain economic factors that are working in our favor that help insulate and protect our real estate market.
I agree 100%. And the thing that people lose track of, and this is another statistic that we came up with or found when we were researching everything, and I don't remember it verbatim, but you always hear people talking about the birth rates, and they group all the millennials and different generations, and when they become of buying a home age, or they typically become homeowners, and they're all this talk and everything, and we're creating so many more household needs as a society than we were just 10 years ago, 20 years ago, 30 years ago. And we can't keep up with the demand. And it goes back to what you said before. It's supply and demand. And when you cannot build the houses as fast as you need them. It's supply and demand. So will prices drop? No. The reason why prices dropped before, you had too much.
Yeah.
And the only way you can get the prices to drop, the only reason the prices dropped is because you had to cut them, which is exactly what we saw happen with the mortgage bonds. Then that chart I showed you, there was too many. All of a sudden, you had this surge of bonds on the market, and the biggest buyer, the U.S. government, stepped out of the market and said, "I'm out." And you had to let normal supply and demand take over, and there just wasn't enough buyers. So in order to entice people to come in and buy, they had to drop the price. And that applies to any commodity. Doesn't matter. Any commodity. And when you can understand that and you can understand the economics of it all, and you take that into consideration, it changes. The other thing that people don't talk about is the fact that the Wall Street firms, the investment companies that bought up a bunch of the single family homes and converted them to rentals, that supply is taken out of the supply of homes right now as well. They're now rental properties. And that is a niche or community or communities that we need to go target and be like, look, you need to stop throwing your money away at rent. And if you don't think you can afford, you need somebody to sit down and give you the proper advice and educate you. If you don't have enough money for your down payment because you gave it to them for your security deposit, we can get you down payment assistance money. You can get into a house with 0% down. You just need somebody that can give you guidance and a plan to help you out and get you out of that rental house. Because when you see the numbers of how much you're throwing away on rent versus how much money you could be building for yourself, you won't be in that house for long renting. You need to become a homeowner. And I think you were touching this earlier. It's the net wealth you build, and the investors, the American investors, the millionaires, they built it all through home ownership. And it's the way to build wealth in America.
Oh, it is. So that actually leads me into the next headline. I know I sent it to you in the last couple of days. And I know that you're addressing it in a series of videos, but I also think based on what you were just talking about, it kind of leads us into that. But there was a story posted by the Washington Post that basically said how difficult it was for millennials to purchase right now. And throughout the article, it talked about how we are the unluckiest generation, which I actually went and looked at who deemed millennials the worst generation. It was the news that deemed it. And
Not to say.
I was like, you don't get to call us the unluckiest generation. But they're saying that for millennials, it's super hard to purchase a home. And I understand in a certain level, because I bought my first place in Nashville back in 2014. And the price that I got it for, it's very hard to find that, especially I think I was within 12, 15 minutes of downtown Nashville. So, to get a townhome for that price, below 200,000, it's hard to do that now, it really is. But so yes, our prices have gone up, but there's still opportunity here in Nashville. There's still opportunity for those that are looking to purchase, whether they have, a $200,000 budget or a $2 million budget. Like there's still opportunity here. And it really is a great opportunity in multiple ways if you're looking at it, because you get into a market that is, all projections are pointing north. We're moving up. So it's great from an equity standpoint, but there is that opportunity that's still there because, like you were saying, you guys, there are methods to help people get into homes these days, especially if they are that first time home buyer.
Yeah. God, there's so much I can say to that.
Because I just, for me, the thing that scares me the most about headlines like that is, say somebody comes from a family that maybe within their family line, there's not a lot of real estate investing going on, right?
Right.
So they're not super familiar with the process. You hear these headlines, but yet in Nashville in particular, there's still opportunity. But if you're listening to the headlines, you may either not believe you can purchase, or you may believe that there's just no option for you. And yet you could be missing out on major financial opportunity. I mean, I know that I've got some clients.
Not good, you are.
Yes. But I mean, I know that I have clients that are sitting on 6 figures of equity within the matter of 2 years. And I tell people, especially first-time home buyers, when I'm meeting with them, because especially if they don't have a whole lot of understanding about real estate. I mean, when I bought my first place, I was just like, I'm buying a place. I didn't understand the bigger picture with it. And I always like to try to explain that to people, because unless you get a major job change to save 6 figures, what other method is going to produce that in a short amount of time?
There's not, unless you get lucky with the lottery.
Yeah, exactly.
I mean, that's about it. Good luck with that. Let me go in with you on that one. You got the lottery number machine, whatever.
But that's like why those headlines are scary, because you and I both know, even as what we've talked about here is, our market's not crashing.
No.
Are interest rates the best they've ever been? No, but it's cyclical. And we're not saying, hey, even though we expect them to come back down, we're not saying, hey, you should continue to wait to purchase, because one of the things that, is important to consider in that is, the way home prices are appreciating here, what you can afford today, especially if you're someone that's like a first-time home buyer or in more of those entry-level price points, what you can afford today, unless, again, you get a major job change, that house is going to be worth even more next year, and it may be out of reach next year.
It will be out of reach.
So you look at all of that, and it hurts my heart for people that if we as the professionals in this industry are not doing the educational piece, we are hurting those who do still have that dream of home ownership, but maybe don't realize it's more achievable than what they think, because they're bombarded with headlines.
No, I mean, you're 100% spot on, and we're working on putting some new stuff out there on Instagram, TikTok, and everything. We were going to do more of a deeper dive into this stuff, but it's such a pressing issue. When we do our bigger videos, they're deep, and we've got to get it out there. So we'll somehow get this tied with you with the timing of this thing going out, but we'll do something that shows everything that you just talked about. I mean, from the cost of waiting. I mean, if you haven't been able to save the money now, what's going to change between now and 5 years from now? And how do you quantify how much that's going to be, how much more you're going to need? And when you see those numbers on paper, stop kidding yourself. I mean, for real, stop kidding yourself. When you can buy now, you need help with down payments, piece of cake. So let's say you're self-employed and you don't have 2 years of self-employment. You're going somewhere else and somebody's told you no. We've got a program. If you got a good credit score, 20% down, and you still got money left over in the bank, you're done. You're closed. Literally. Good credit score, 740, 20% down, money left over in the bank for reserves, you're closed. I don't care what your job is. I can get around that. Same thing, I can go down on that program to like a 660, I think, but I think you got to put 30% down then. But still, if you got cash, most self-employed people have cash. We use this a lot with different ethnic groups. The Hispanic community, they have tons of cash. The Asian community, they have tons of cash. There's all sorts of other communities that have tons of cash. They're very creative with the way they do their stuff. And yet, when they try to go get loans, it's difficult to get loans for them. Let's say it's You got a bartender, you got somebody that does nails, you got somebody who does your hair. Heck, you as a realtor, you guys as a self-employed person, the tax code says write all your income off and show yourself broke so you don't pay any taxes. You're paying it through other means, but show yourself broke. Well, when you come to me, the lending law says, hey, gotcha, because if you don't claim it, you can't count it. So now you can't qualify. So we have these programs that basically say, okay, we don't care about your tax returns now. I can go off that same program I just said before. If you got the down payment, the credit score, the money in the bank, the reserves, piece of cake, closed all day. Bank statements, I can use bank statements to qualify. If you get paid on a 1099, I can use that instead. I mean, there's a lot of options to get around qualifications, and not a lot of lenders are armed with all the stuff. We have portfolio loans. There's companies with niche loans. I mean, there's all sorts of options out there to get into the game. One of the best times, and don't by any means, and I'm hesitant to say this, don't just think the first of the year is the best time to buy.
Sure.
It's the best time from having the most options, because there are down payment assistance programs that we are part of, and we have a bunch of niche ones because of the size of our bank and everything else that we utilize and tap into. But that this year those funds ran out in April, I believe, and it was $10,000 that they would give the home buyer, and in April the funds were gone. So that's why I'm saying, hey, if you're going to do this, you need to start looking now. You need to start making you get your financials in order. If we're going to go through a down payment assistance, you're going to do something like this, you need to start looking now. Make sure your credit's is where it needs to be. That way you have time to get anything fixed. You need to get everything squared away with Caitlin, so you guys know what you're looking for. You can start going through the drips and looking, okay, this is where we need to be. We can make sure you're looking in the right price range. And then at that point, if we're going to target and do it after the first of the year when these programs open back up, if you need that down payment assistance, boom, there it is, and you're ready to go. The only downfall of that is how much is the prices of homes going to continue to go up over the next 4 months, because that is a real thing to consider. But if that's the type of program you need, it is what it is. It's better for you to get into the game then than to continue paying rent and never get into the game, because the longer you stay out of the game, you continue to cost yourself thousands and thousands and thousands of dollars every single year. And when you see some of these comparisons we send out, it's going to blow your mind, because you don't see these things in the news. You don't see these things online, because they're not financial advisors.
No.
We take a financial advisor approach and show you the numbers you need to see. And you can turn around and take what I give you, and I'll tell you exactly how you can go out and vet it out and calculate it through a Google calculator and make sure you feel comfortable.
Well, and one thing, and we don't have to do a deep dive on it, but there's a couple of thought processes even there is, as like, yes, we've got more inventory than what we had when we were dealing with our white hot market, right? So there is opportunity for buyers, especially right now. Yes, interest rates are higher, but instead of having to compete with 30, 40 offers and go exceedingly over list price, now there are still, depending on price point, depending on if the home is showing well, there still could be a multiple offer, but you're going to be competing against maybe 2 or 3 versus 30, 40. And if you're not in a multiple offer, depending on the home, then you have far more negotiating power right now, right? And so, if people want to take the line of thought, because there's this video that I've seen going, all over Instagram, but it's like, if the rates all of a sudden tick down and down and down and down, when that happens, especially in Nashville, we're going to watch more buyers flood, which means more multiple offers are going to come back. Right now, what we're dealing with is and I think this is a whole separate video topic for us to talk about in terms of sellers not wanting to sell because they don't want to trade their low interest rate, because you've got a great perspective on that, which again, we don't need to dive into at the moment. But that's another thing that's keeping our supply low.
Absolutely.
Which, as again, we're talking about supply and demand and what's going to happen with Nashville. You know, if it comes down, we could see some more sellers being willing to come to the market.
Yep.
But you're also going to see buyers all of a sudden, those who've been sitting on the sidelines, who are genuinely feel like interest rate is what's going to drive when they want to purchase. We're going to watch it happen again, where it's going to go multiple offers. So there is still opportunity between, you know, first-time homebuyer programs, down system programs. Yes, there are higher interest rates, but there can be options to refinance, which you have a great way to do that, to where it's not pulling out a whole other chunk of cash to make it all happen. But there is opportunity. But at the same time, you're in the house and you're starting to build that equity, which is a massive piece of the puzzle. Plus, it's your place where the money that you pay to the mortgage is actually going towards, you know, you building that equity that's coming. Whereas with rent, it's literally paying off somebody else's mortgage. It's their investment.
Yep. I'm glad you said that, because I don't want people to take what I said as, oh, you need to wait, because there's a lot of videos I've done that I have said the exact opposite. And I am completely on the side of, and I've been saying this for months, that video that you mentioned, that's a great video. And I've been saying that for months. As soon as the rates drop, people will flood back into the market. And as soon as the people flood back into the market, the sellers are going to be like, I'm no longer giving a discount. Why? They don't have to. So
they get the pick of the litter in terms of the offers.
And now you're back to those multiple offers. You're back to the bidding war, and you're going to continue to escalate the property values up. And why? Because there's no supply. So it comes back to that supply and demand issue. But you touched on so much that was there, that was very, very good. I mean, there's so many there's so many things. There's so many things that people, I guess the best thing the best way to summarize is, if you have any thought of trying to buy between now and the next 2 years, start now.
Absolutely.
Start now. Get pre-approved and let's see what you can do now. If we can make it happen now, yes, rates are higher. Rates don't suck. I like to say they suck. Rates do not historically suck. They're higher. But if you can get into the house now, and you can get it for significantly less, and when you look at those numbers side by side, and you can see how much less that purchase price helps you, that slightly higher rate is peanuts in the grand scheme of things. It's all psychological. When you look at a payment 5% to 7%, it's not that big of a difference. It really, really isn't. And then when you can turn around and you see the trend in the history, and you know that the mortgage rates are going to drop, and you can turn around and refinance that house with almost no cost, in some cases zero cost, you're going to turn around and drop your payment $200, $300, $400, $500, depending on how much your mortgage is. And now you're going to be in that much better position. But the key thing is, you bought it right. You bought it at 50 grand, 100 grand, or whatever lower than the market is. If you wait and you come in when the rates drop to 5% or wherever they drop to, and now the market's flooded in, now you're paying 50 to 100 grand more for the property. It doesn't matter what that 5% rate did for you, because now you're financing on your principal balance 50 to 100 grand more, and that rate doesn't matter. In your head, you think it does, but on paper, you just lost. You think you won, but on paper, you just lost.
But that again goes back to if those of us in the industry are not diving through the charts and the numbers and sharing this, and people are only listening to headlines, they're missing out on opportunity. And at the end of the day, you know, one thing that I tell people is like, again, because I worked in the industry, I know that they use those keywords, right? Like empower, protect, like whatever those like 3 little keywords are that they say in every
power, protect, and serve or something.
Yeah, all of those, right? They all end up being a bit of subconscious programming in a way, because when you internalize it, you do believe like, oh, they're here to empower me and protect me and whatever. But at the end of the day, I've sat in the meetings where you have the consultants come in and they tell you how to make your newscast better. And not in any of those conversations did that consultant ever say how to better the life of the viewer. It was all about how to drive their ratings, because you have the advertisers that are paying. The advertisers want to see results, so they've got to drive viewers. And unfortunately, fear is a powerful motivator. You got to keep tuning in for what's coming next and what's the next tragedy and everything. And so, you know, this doesn't mean, and I always like to preference it, it doesn't mean that if you know like the best person ever and they work in the industry, it's not a person specific, it's an industry thing. And there can still be great, well-intended people within the news industry, but at the end of the day, when they're putting out content when it comes to real estate, you know, they're not doing it coming from a heart of trying to serve people and their interests the best. They don't care if you're financially sound. They don't, they really don't. And so that's where, you know, for me, it's like, and again, I know that a lot of times real estate agents can come off as dirty car salesmen and we're just in it for the money, like cut, run, see you later. But that's like part of my mission and my team's mission is to show like, no, there are those of us that like, we genuinely care. We like care about your interest. We like care about making sure that we take care of you. And so like, if people are hesitant, you know, you're saying if they want to purchase in the next 2 years, you know, if it works out that financially it's a great move for them, awesome. But I mean, I know that y'all and my team, we're never going to like force somebody into a home just so that we have a paycheck at the end of the day. So I tell people, we've worked with people and they've come in and we've gotten them closed within 30 days because that was what they needed. We've also worked with people across multiple years to find the right place. So it's like, if you are really genuinely concerned about someone being a hard sales, don't partner with a lender that's just going to try and shove you through the process. Don't partner with a realtor that's going to just do it because at the end of the day, they're serving their own interest, because there are those of us out there that really actually care. And we want it to work. And we want you to fulfill your dream in a way that makes sense for you when that timeline does genuinely work. And so all of that to say, that's not saying like, oh, don't buy now, wait. It's looking at what are your options, giving you the facts and the figures of what's really happening in the real estate world and the mortgage world, and then allowing people to make the best informed decision for themselves once they have everything laid out on the table.
It's spot on. I mean, the only thing I could add to that is everything that we provide or give you is, I mean, there's times I'm talking to clients and they're like, well, I'm talking to so-and-so. I'm like, well, did they tell you this? No. Did they provide you that? No. Well, what about this? No. I'm like, you're purchasing the largest investment in your life and you're not dealing with this? You're not getting this? I mean, I was like, whether you use me or not, don't use them. Everything we're going to give you, like everything you've seen that we've given you here, it has a logo on it. It's telling you where it's from.
Yes.
You can go find it. You can go verify it. We're not standing out here with a megaphone, blah, 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 just shouting a bunch of at you. I give you the numbers, detailed numbers. You may not understand them when I first send them to you because, whoa, that's a lot of stuff. But when we walk you through them, you're like, got it. I get it. And you can easily go out to your calculator on your phone or online and run the same numbers yourself. Black and white numbers don't lie. People lie. Black and white numbers do not lie. And when clients ask me, hey, I want to go talk to my financial advisor about it, it's fine.
Mhm.
I have honestly been in the business for 20 years. Never had a financial advisor say, that's good, make that work, and tell me no. Don't do that. That sucks. That's a bad plan. So I'm very proud of that. And we do things, our whole business
Mhm.
is built on referrals. And there is not one single transaction that's worth shoving through, doing any fraud on, doing any kind of misrepresentation, or screwing you over on, because that one deal could be the deal that sinks you. And I've been in it for 20 years. And I'm not willing to trade that in for one transaction. And on top of that, if we take care of you, then you'll take care of us. And that's how we do our business.
Yeah, exactly. And so that's like why I feel like this conversation's been really good, and kind of in summary, basically the bond market's not on the verge of crashing.
No, absolutely not.
It's
just being crazy.
There's a lot in there. But and everything with the real estate market is cyclical in terms of what's happening. And so, again, there's things that we can't predict in terms of if COVID part 2 rolls around or whatever, all of that. And actually I have one last question for you, because I meant to ask it earlier.
Yeah.
But, do you see, and again, this is not meant to be political at all, but do you see elections affecting what happens with interest rates?
No, because that everyone's gonna have an opinion on that, because everyone has an opinion on politics. I keep that separate. The only thing that's gonna change then is you're gonna have a new Fed chair. The problem with the Fed chairs are they're typically attorneys. They're not economists. And the problem with that is that attorneys are trained to protect your interest. So they're defensive in nature, pessimistic in nature, I guess you'd say, which you want as an attorney. You want them protecting your rights and protecting your assets and everything else. They're not optimistic. They're not economists. And they are very black and white, which is why I said what I said earlier. They're looking for 2% on their report. And until they see 2%, they're going to keep driving forward, which is exactly what they keep saying in their statements. So until you have a change at the top that might change the Fed chair, nothing's going to change, because right now their focus is driving this thing to 2%. And the jobs report, and the things that happen between now and the Fed report, or not the Fed report, but between the economic data between now and September 19th and the 20th, when the Fed meets again, is really going to be the tipping point. We're either going to have our crest at September 19th and 20th when the Fed makes their announcement on the 20th, or it's going to be like, hold on for a little bit. It's going to get a little bit bumpier. But the worst overall is truly behind us, even though it could get a little bit rougher
with interest rates.
Yeah. But if at the same time, when the Fed overdoes it, one thing I didn't show you that we need to show real quick.
Oh.
Can you see this unemployment?
Sure do. Yep.
Okay. So the problem is the Fed changed, or I don't know who's responsible for it, but I guess it's the Fed. The BLS, the Bureau of Labor and Statistics, they changed the way they calculate jobs. And the new report started January of this year. And they won't tell you how they do it. And there's a lot of inconsistency with the way they do it, or with the way their numbers are coming out. They look at the way businesses open and close to try to estimate the stuff, they estimate the jobs that were created instead of things like the ADP report, which is a payroll company that actually says, hey, we had X number of payrolls last month and we now have this many, and here's your jobs that were created or lost. Very straightforward, very simple. You don't get that information from the BLS report. And what information you do get, you can see a lot of it's part-time work. So there's a lot of holes in it. And I tell you this because you can go through and look at a lot of the other data. You can look at what was the other one? ZipRecruiter, I think, was another one that just released a bunch of data. They've been sounding the alarm the last 3 quarters that their earnings are down because hiring is down. So, I mean, there's a lot of things you hear in the news. Layoffs. They're all over the place. But yet, job report keeps on kicking, keeps on defying the odds. It's only a matter of time. And the point of it is, when it does settle in, that's where it's going to finally crumble, because the jobs report is always a lagging indicator. It always is the trailing report that leads to everything. And this report shows that that's exactly it. And every one of these bars, again, are the recessions. And you can see how the Fed hikes and hikes and hikes and hikes and hikes. And right afterwards is when they finally start to cut. But the recession is always after the fact, because you never can future predict a recession. A recession is always a rear looking confirmation. You've got to look backwards in order to confirm it, and it takes time to confirm it. So that's why you're seeing this. But once the economy starts to stall, once the jobs start to fall off and all that stuff finally starts to cycle through, because again, it's kind of like what I said before, it takes time for all these changes to cycle through. Once they cycle through, it'll finally hit, and then they'll start to cut the rates. So there's some people that basically say that, hold on, the economy is not as strong as everyone makes it out to be, and we're going to get to this end game quicker, and this stuff can turn on a dime. We've seen it turn on a dime really quickly. So what I'm telling you is not, again, just me just pulling stuff out of the air. I can go back and give you the facts. I can give you this stuff in history. If you want to sit down and talk to me, I'll be glad to share it with you. But it's just a matter of, again, understanding the history, the data, the trends. But the big, I guess, the takeaway to button this piece of it up is, ultimately, it depends on what the Fed does September 20th.
Okay.
If they see the writing on the wall, and and they'll take into consideration the trend, and they pause, I think you'll see, and they don't come out with some firm, aggressive verbiage that spooks the market, you'll see the markets respond positively. That's what they want to hear. The markets want to hear, okay, we're good, we're moving forward, we're going to start to improve. But if they continue to hear, nope, we're going to continue pushing forward, we're going to continue tightening, there's work to be done, you're going to see the rates go up a little bit more, and the Fed's basically going to push us into a recession. And that's what this shows, is over the course of history, or over the last 60, 70 years, the Fed has always pushed us into a recession. It happens every time when you're in this situation. They wait too long to react, to get in front of inflation, and they push the issue too far, and they push us over the edge. And that's why I said before, it's not going to be a smooth landing. It's going to be a little bumpy crash, but it's going to be short. But you want a recession. A recession is good. The quicker we get to the recession, the quicker the rates drop, the quicker everything goes back to normal. The quicker we get there, the quicker it gets back to normal. That's the best thing I can say to take away from this.
And like we said, as rates go down, that could bring
Because inflation goes down.
Yep. But as rates go down, it's most likely to bring more buyers back to the market.
Not most likely, they're flooding back to the market.
Yes, in Nashville especially.
Yeah.
We're talking Nashville specific.
Yeah.
Bring them back to the market. and then negotiating power for buyers can go down at that point. So it's a bit of a wild ride, that's for sure. Being, you know, real estate is not black and white like they like to make it seem on HGTV. There's a lot of complexities in it, and what plays into it. And obviously the mortgage world, we work hand in hand. But I just feel it's like pressing desire that as we continue to see these headlines come out that can be scary, that can be, you know, not telling the full story or not telling any of the story, you know, it's just really important that those of us in this industry are actually out there giving context and education to what's going on. So I think that's really important, especially right now with just even just the headlines we've talked about. And there's so many more out there, but just, you know, if we are not doing our job in giving context or speaking to what's being put out there, then I just feel like we're doing a big disservice to potential clients out there. So
agreed.
Mike, thank you so much for joining me.
Absolutely.
We will take those 2 videos that we mentioned, the Instagram video and the other one. We'll link those down below so that people have reference to that, as well as social media pages and how to reach out to you. But thank you so much. And we'll do another video where we're talking about, you know, what sellers need to know as we kind of go through this market as well. But thank you so much for all of your commentary and explanation. It was super helpful.
Absolutely. Anytime.
Awesome. Thank you.
All right. Take care. All right. See you. Bye.
So I hope you enjoyed that conversation. Again, I know it was lengthy and I considered breaking it up in part 1 and part 2, but it all just led one thing into another. And like we talked about in the video, when you look at the charts, when you look at the statistics, that actually paints a different picture than what a lot of these headlines are saying. And again, at the end of the day, our goal is always to just give people as much education as possible, especially if the most that you know about real estate is going to be through headlines. And so again, we're not doing our job if we're not taking what those headlines say and taking a look, because real estate and the lending industry, they are not super simple industries. There's a lot of complexities that play into it. So again, I hope you enjoyed today's conversation. If you've got any questions for me or for Mike, please don't hesitate to reach out. All of our contact information is below. If you are thinking about making a move to the Middle Tennessee area, please do not hesitate to reach out to me. There's actually going to be a Calendly link down below where you can click and go ahead and there's actually going to be a Calendly link down below where you can go ahead and book a Zoom discovery call with me to talk through what your needs are and to see if we're a good fit. If you're not quite ready for that yet, there is a free Nashville relocation guide down below that you can click and download. Again, my name is Caitlin Merton. I'll see you next time.